In this video, I will show you 3 stocks to buy now if you want to outperform the market. I believe if you buy these 3 stocks at current prices, you have a very good chance of making 10% per year, 15% per year, maybe more, but you have a good chance of outperforming the market. And full disclosure, I already own 2 of them. So I have strong conviction in these picks. And I'm actually monitoring the third one to potentially buy it. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in these kind of opportunities. So let me start with the first one. And the first company I want to talk about is Fortinet. Fortinet is a company in the cybersecurity industry. And the thing that I like is you have a quality management for a quality company, and now I believe it's available at a fair price. So let me read the description. Fortinet is a platform-based cybersecurity vendor with product offerings covering network security, cloud security, zero trust access, and security operations. The firm derives a majority of its revenue through sales of its subscriptions and support-based business. The California-based firm has more than 800,000 customers across the world. The CEO is still the founder, and you have actually 2 brothers, one CEO, one CTO. The Z brothers that have together 15% of the company. Okay, let me repeat and add more elements to it. You have a business with very high margins, 80% gross margins. You have a company located in a growing industry. Based on the latest information from Statista, the cybersecurity industry is expected to grow at 12% per year. And Fortinet has always grown better than the market. So you have a company that is almost guaranteed to grow minimum 12% per year. The founders are still here for the past 20, 25 years. They are still controlling the whole organization. You have a very nice margin profile. You have, look at this, a revenue growth that is literally up and to the right, a free cash flow growth, look at this below, up and to the right. We are talking about the business that can grow sustainably by 15% per year. It can be 20. I mean, they've done 23% per year for the past 20 years. So you have a company that can grow minimum 15% per year. Let's put it this way. They don't have debt. They don't have a debt problem. They are net cash, which is quite good in this environment to have this kind of flexibility. And what do they do with this cash and this strong free cash flow generation? They are paying shareholders with buybacks. And now, actually, the stock has crashed. Maybe you are following the news. And the stock has crashed meaningfully based on the latest earnings report, and they did the biggest buyback ever. So that means the management is very bullish on the company. The management thinks that the company is cheap at the moment, and they believe it's better to invest in themselves. Okay, you have a ROIC that is at 20%, which means a lot of efficiency. And they don't pay a dividend. They just focus on shareholder returns through buybacks. And look at this. This is the year-to-date performance of the company, minus 14%, when at the same time the S&P 500 is growing. Yeah, look at this, 12%, plus 12%. So you have a clear discrepancy. And the reason for this discrepancy is the valuation. In the past, valuation was quite excessive for Fortinet. You had a PE ratio of 40, and now the PE ratio has dropped. We are at 30, 29, free cash flow, price to free cash flow of 30. I mean, I consider this to be fairly valued. And I opened a position to Fortinet after the drop at 75. And I'm contemplating buying more. I'm monitoring the situation. And the more I look at it, the more I want to buy more shares, actually. So I will be biased, obviously. And this is part of the bullishness, I suppose. Just so you know, this is not the first time I bought Fortinet. I also bought Fortinet when nobody wanted to touch it in late 2020. And I sold the position at the top here for a quick triple in 1 year. Now, I see this scenario happen again. This is not the first time I see worries about the company. If you want to know why the stock dropped, it was because of some comments from the CFO about the renewal rate of new things. Basically, Wall Street expected too much of this company. And because the company is a steady train, they only grew by 15%. What a panic attack you should have, right? Wow, that is so bad. A company that is only growing 15% per year. So bad. It will go down. Yeah, the growth rate is decelerating to 15%, but it's not the first time it happens. It has fluctuated in the past. It's all about renewal, etc. But don't forget, you have this baseline of the cybersecurity industry that is growing 12% per year. And actually, if you want to check the competition for this one, the competitors, you have Palo Alto Networks. This is the biggest cybersecurity company in the world, available in the public markets. So you can check Palo Alto Networks here. And in terms of market cap, this is the biggest one. And guess what? They are all also growing by 15% per year. And they are trading at an excessive valuation. Price to free cash flow of 40, more than what we've seen. PE ratio, forward PE ratio of 50, more than what we have on for Fortinet. And most of the cash flows are because of the SBC, stock-based composition. So maybe you have some small adjustments to make. What I want to say is Palo Alto Networks is growing 15% per year and people love it. Fortinet is growing at 15% per year and people are doubtful. Well, I strongly disagree, and this is the reason why I'm buying. I think Fortinet is a very good buy right now. The markets are at all-time highs. You don't have opportunities? Yes. Yes, you have opportunities. This is the definition of a quality compounder available at a fair price. It's not a cheap, completely cheap price, absolute cheapness. I agree with you. But it's a fair price for such a quality company, and the management owns 15% of the business, and you have a clear tailwind from the growing industry. They are in a very good spot in this market. They have a clear leadership, the margins are increasing, and they are rewarding shareholders through dividends, through buybacks. So the management team is loving the shareholders. Everything available at a PE ratio of between 28, 30. This is fair to me. Fair to me. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Okay, next one is MSCI. I also own MSCI. You probably know this company because they create the indices, the MSCI World Index. This is their biggest segment and the most profitable ones they have. But they also have an analytics segment, an ESG segment, and a private equity segment. Spoiler alert, only the first two count. The index and the analytics segments. Okay, two segments are growing, and when the market is growing, the S&P 500 is going up by 12% this year. This stock is flat, minus 3%. Again, in a market where we are all at all-time highs, you have such opportunities. Look at the margin profile. Gross margins at 80%. Operating margins at 50%. Net margins at 40%. Free cash flow margin at 45%. Can you name 10 businesses with this margin profile? It will be very hard. This company is growing around 13 to 16% per year. Fair enough. If you look at the revenue, it's a smooth line up and to the right. Net income, it's a smooth line up and to the right. If you look at the free cash flow, look at this, in free cash flow in blue. It's a smooth line up and to the right. The earnings per share is going up. And what do they do also? They are doing buybacks. Almost every year they are doing buybacks. And they just increased their buyback program very recently, a few weeks ago. Same thing for Fortinet, by the way. Fortinet also increased their buyback program because they think they are cheap. And for MSCI, we are now available at a forward PE ratio of 30, price to free cash flow of 33. 33, so the forward price to free cash flow should be even lower than this, below 30. A company that can't be disrupted, a company that doesn't have much debt actually. The leverage ratio is, I would say, normal because they provide a lot of free cash flow and you have a lot of resiliency and stability. The main issue and the reason why the stock is down is in the past, the stock was overvalued. In 2021, it was the rise of the ESG phenomenon, and they were riding this wave of ESG that was growing like 30% per year, 50% per year. So Wall Street expected this ESG segment to grow and grow and grow forever. Turns out ESG was like a fad, and now it is not growing anymore. So this growth opportunity went down in only 1 year. But at the time, in 2021, the PE ratio for MSCI was 60-70. Very high. So now the ESG segment has slowed down. The valuation is more reasonable. PE ratio of 30. Again, you have a beautiful compounder. The CEO has been here for 30 years. He owns 3% of the shares. And fun fact, he recently bought more shares for his personal account, his own account. After the... let me give you a lot of value here. After the drop of 8%, I believe it was here in July, they reported a earnings report, okay, minus 8% in 1 day. 2 days ago, the CEO bought more shares with his own money. This is not the first time he does it. If you look at what happened last year in 2024, here in April, the stock dropped in 1 day, I think 13% or something like this. Guess what? 2 days after this, the CEO bought. And it was the local bottom for this one. The CEO knows when the stock is cheap. The CEO is buying shares with his own money. And he's doing it again. And MSCI just increased its debt level to do more buybacks. How many signs do you want? You have a quality compounder that will benefit from a lower interest rate environment, that will continue to grow around 15% per year, and will give the shareholders dividends and buybacks. You have a dividend yield of 1% and a buyback yield of, let's say, 2%, 2 or 3%, they can increase it. Available at a PE ratio of 30, price of cash of 30. A quality, great company available at a fair price. This is by picking these stocks that I have generated 25% per year. This is not after going after value plays. Don't try to be smart. These are, even these two, these could be very good candidates if you really are a quality investor. You always have risks. The investment pitches are not perfect. The situations are not perfect. But in overall, you won't find many opportunities like this. Fortinet and MSCI are very, very good businesses. And we are definitely in the sweet spot of a great company that is met with a reasonable valuation. The third one is a European company called Lotus Bakeries. They do the speculoos Lotus biscuits that we have in Europe. I don't know how famous they are in the US, but they are quite famous here in France. And this is it. This is a biscuit company from Belgium. The market cap is $7 billion. And the stock is recently down, on a year-to-date performance, minus 23%. But look at the 10-year chart. You will change your mind very easily. This is one of the few European businesses that have outperformed the market. And this is the reason why I am monitoring this, because I know this stock has a lot of potential. In terms of margin profile, it's good when it comes to the biscuit industry. And if you look at the fundamentals, look at the revenue. Going up 10-15% per year. Net income up every year. If you look at the free cash flow, well, it will be a mess because they have, right now, there are capacity constraints. They will increase the CapEx program because they can't meet the demand. And this is the reason also why the stock is down. If you look at the past 3 years, at the top, it was $12,000 or euros, and now it's 8. So below highs were 34% decline, which is okay. I mean, the valuation was sky high and valuation has come down to reality. This is the first point why the stock was down. So we have a forward PE ratio of 35. Okay. And I would not consider the price to free cash flow here because you have a massive ramp up of capex coming. And the second reason is the company has some temporary issues because they have a lot of demand, but they don't have enough supply. So they need to have some costs, reinvest in new facilities to meet the demand. This is a great problem to have. You have your customers that they want to eat more of your biscuit. You have more people wanting your stuff. So you need to invest in yourself, invest in more people, more employees, more facilities, manufacturing plants, etc., transport, logistics, because you will make a lot of money in the future. This is a great problem to have, and this is the reason why the stock is down, because you have worries, how much time will it take, etc. I think even if you buy right now, you have a decent chance of outperforming the market. I would wait a little bit to personally buy it for my taste. It's a little bit too expensive, but if it drops a little bit, a tiny bit, I think I will open a position because I think it's a great business. So these were 3 stocks to buy now, and I think if you buy now, you can outperform the market. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.